This week in accounts, we will be looking at double entry bookkeeping. Before we actually get started in double entry bookkeeping, before we actually take the transactions and apply them to the different accounts, and I show you how to do that, we need to understand the different classes of accounts. And there are three main classes of accounts, and as you can see on the screen, the first type we have is real accounts, and these are the asset accounts of the business. So for furniture, motor vehicles, machineries, fixtures and fittings, anything that deal with permanent assets, we class it under a real account. Current asset could be classed here. Remember, there are two types of assets, fixed and permanent, and they are both under the real accounts. The next type of accounts we have personal accounts, and these are the accounts for the debtors and creditors of the business. So people who buy products from you and the people you buy products from, which are the debtors and creditors, they have personal accounts for the business. The third type of account we have are nominal accounts, and these are the profit and loss accounts of the business. So for example, if we paid an electricity bill of $500, that is registered in a nominal account. Next, we will look at a table classifying examples under each of the headings, and I will go through that just for you to have a better understanding of it. On the slide on the screen now, you will see a table with 3 columns classifying accounts under real, personal, and nominal. This picture was adapted from a book called Principle of Accounts by Faye Thompson Hussein. And in this book, basically, they went ahead and they classified each type of account that we could come across while doing double entry bookkeeping underneath the different headings. And if you look on starting from your left, you will see real, the heading real accounts. Under real accounts, there are different types. We have cash in hand, we have cash at bank, we have stock, furniture, fittings, equipment, motor vehicles, plant and machinery, land and building. Notice they put both the fixed and current assets under real accounts. Next, we move on to personal accounts, and they give some examples from the textbook, basically based on their transactions. Okay, so maybe we don't come across a J. Smith and Company Limited, but this is just to reiterate an example of a trade debtor or a creditor for you. And they, under the trade debtors and creditors, they had J. Smith and Company Limited, PNB Minimart, Joseph Ross, capital, drawings, loan accounts, mortgage accounts. Okay, so key points: look at capital, drawing, loan accounts, and mortgage accounts. They are also personal accounts. The reason why they are personal is because a mortgage, loan, drawing, or capital is based on the owner of the business. Every time you add capital to the business and you take money from your personal account, it is personal. When the owner of a business withdraw money for personal use, that is drawings, it is personal. Loan accounts: every time the owner of a business pay a loan or a mortgage towards an account, it is also personal. Now we go on to the nominal side, which deals with the profit and loss or the expenses and revenue of the business. Expenses of the business in most cases will be advertising, wages and salaries, sales and purchases, sales returns, purchases returns, telephones, discounts allowed. Revenues, examples of that will be anything the business receive, and sometimes they receive interest, commission receive, and discounts receive. So you need to understand the different classes before we get into double entry, because in double entry we have something called a debit and a credit side, and if you unsure of these classes of accounts, you're going to mess up the double entry because you wouldn't know which account gains and which account loses. Now we go on to the structure of a T account, and a T account is basically a ledger account, except this one we can draw it with a ruler and a pencil. We can draw a ledger account as well, but that usually is time consuming. The T account, you just draw a simple T on your book, and that usually does the trick, right? So before we get started, we need to look at the different parts of a T account. So if you look on your screen, you will see abbreviation for debit, which is DR dot on your left hand side at the top part of the screen. This means debit, and the debit side of the account is always the left hand side. And the debit entry is an entry made on the left hand side of an account, and the opposite of debit on the other side on the right hand. Now you'll see CR dot, which is abbreviation for credit, and that is on the right hand side of the account. Every time the business gets money or increases in money or have money coming in, whether they a customer pay them, whether they get money from a return, it goes on the debit side. Every time the business lose money, so let's say I paid $5,000 for an electricity bill, it will go on my credit side because I lose money. Okay, notice on top you have the account title. You'll notice cash account. A/C is the abbreviated version for account. You need to put the title of the account at the very top to understand which account we're dealing with. Date, details, and amount goes on both the debit and credit side. So you're opening up, basically you're writing the same heading on two sides of the account. And if you look on your screen, you will notice a transaction at the bottom. June 1st, 2020, M. Marshall paid for cash products $14,000 and I entered it into this T account for you. As you can see under the date, we put June 1st, 2020. Under the details, we put M. Marshall because he is the debtor of the business and he paid for cash products of $14,000, and we put that on the amount, which is the money, we put it underneath. The $14,000, we put it underneath the money or the amount column. Notice everything underneath the heading, you will find a transaction. You're going to find the date. The details will be either the name of the real asset or the debtors or the creditors, and the amount will always be the money, the how much it's worth. Okay, sometimes you might have to calculate how much money, but again, once you calculate it, the money will go underneath amount. Before we get started with actually doing double entry transaction into the account, we need to look at the various rules of double entry bookkeeping. And these are some rules that I would encourage you to learn off, because from time to time you're going to make mistakes with these things. The first rule, all sales are credited. All sales, whether it's a product sale, a cash sale, whatever, however they phrase it in the transaction, it is credited. All purchases are debited. Once somebody buys something from the business, it is debited because that represents cash coming into the business. All sales returns are always debited. So if we buy something from some outside supplier and we return the sales, we will get back money. So this will represent an increase in our money, hence it is debited. All purchases returns are credited. Purchases returns are credited because if the customer buys something from us and then returns it to us, we have to give them back money. From this, we will credit the transaction. The next rule is when we open an account, we open one account for each type. For example, only one cash account. This will work for all transactions. Next rule, when we start a business, we always open the account for the way we start a business and a capital account. For example, if John started a business with $5,000, we open a cash account for John as well as a capital account. Notice the transaction, when they list it for you, they will never tell you open a capital account, or they will never specify capital in that. We need to understand as accounting students that everything we use to start up a business are considered venture capital. Hence, we just open a capital account. The capital account is not specified in the transaction, so the student must know or remember to open it. Last rule, we do not use or open a check account. If the transaction specified paid by check, etc., we simply use a bank account. So if we have a bank account already open, we simply put the transaction into that account. We do not open a check account. Hi everyone, so I'm beginning double entry and I didn't use the board for this. I used the computer, so exactly what I type is what you're supposed to write, okay? if you look on your screen, you'll see several T accounts that I have opened up. Basically, I've opened them up so we could see basically all the accounts that I have to open, but I don't have time to draw. They keep drawing the T's in Excel. It takes time. So what I did, I just copy and paste some tables so that we could get started. The first thing, well, basically in the previous slides, you would have done double entry in terms of double entry in terms of the theory behind it, the different types of accounts, real, personal, nominal. And I went through the rules in double entry, which is whenever we start a business, we used to start up and open a capital account. All checks is for bank, all purchases debit, all sales credit, purchases return is credit, sales return is debit. Okay, so the basic rules. So now I'm going to do the transaction and show you how it's done. On your screen you will have the transactions, so you can take them down, and while I do the transactions, I'll do it on the computer to show you the two accounts you're opening at the same time. Okay, so the first transaction is started a business with $25,000 cash in bank and $700 cash in bank. So for this particular account, we are opening a bank account, a cash account, and remember, when we start up a business, we use capital account. So on the first account, this will be bank account. In my second account, I'll open a cash account, and the third account I'll open is a capital account, as you can see on my screen. Okay, remember, we have date, details, and amount, and we get this information from the transaction. And remember, when we open when we make double entry, the transaction is opened twice in two accounts. Usually one account is debited and one account is credited. In this case, the debit account will be cash and bank, and the credit account will be capital. Capital is always kind of credit account. So we're going to start. The transaction has January 1st, 1999. We could just put 99, just to keep it for short. Right, I'll put a 0 so we can specify date and time. Remember, your date is important, huh? In my details column now, I'm going to put capital, and the amount for bank is going to be $25,000. Okay, and then we will do the same when we open our capital account here. Sorry, our bank account. We have to come across and open the same thing in the capital account, except this time it will be the credit entry. So it's debited in the bank account and we're crediting in the capital account. Okay, so January 1st, 99. The details. Now, when we're writing up accounts, the details of one account is the heading of the other. So the details for the capital account, I didn't mention that before, is bank, and the amount is $25,000, right? And if you look at my bank account, my detail is capital because that's the corresponding account. That's the second account I'm opening for that. So now that's the first part of the transaction, dealing with bank. Now we have to deal with cash. So the same date, January 1st, 99, we have capital account because this is the corresponding account here we're going to use for that. And I'm going to put the transaction have $700. Okay, so this is the transaction in my cash account, and now I'm going to do the same. I don't need to write back the date because it's the same date we're working with. So when I go across in capital account, now my details is going to be cash because that's the corresponding account, and it's going to be $700, right? So that's our first transaction. We open a business with $25 cash in bank and $700 cash in hand. So the account we are opening is bank account for the $25,000, and to correspond that, we're going to open a capital account as I'm showing you right now. And the next part of the transaction said that we also used $700 cash to open the business. So we have our cash account and we have the capital account corresponding to that. So that takes us to the end of our first transaction. Now the second transaction reads: bought machinery $8,000, furniture $3,000, and fittings $2,000 by check. Remember when we said we're using check, we need to use the bank account. So the same bank account we opened earlier, we're going to use, okay? But in this case now we have to open a machinery account. We need to open a furniture account, and we need to open a fittings account. All these have separate accounts. Remember, we paying via check, so we taking money out of the bank to buy this machine, the furniture, and the fittings. So the debit columns will go to the machinery, furniture, and fittings account, and the credit balances will go in the bank because we're using a check. A check is usually issued by a bank, right? So the first thing we're doing on the date, and the date is January 2nd. Details, bank, and the amount for machinery is $8,000, as you can see on the transaction, right? And then we're going across one time in the bank account on the credit side because we're paying money, we're taking money out of the bank, so the bank is decreasing in value, and we're going to buy a machinery, so the machinery account will be debited. So we have January 2nd, 1999. The corresponding account is machinery, and we have $8,000 paid for that, right? And now we're going on to furniture. The same date, January 2nd, 99, we use the bank again to pay for furniture via check, and the amount for that is $3,000. I like to space my thousands with commas, right? So if you see me backspacing to fix that, it's because I want it done perfectly. And we're going now in our bank account. Again, we don't have to put back the date because we already have the date from the same transaction. So we'll just leave the date unless the date changed. Well, it didn't change. So we just leave the date and continue. So we have here now furniture on your bank account on the credit side, because remember we take the check from the bank to buy these things. $3,000, right? Good. So now we're going across now on the fittings account, and it's basically January 2nd, 99, and January 2nd, 99, and sorry, I just have to minus this. I just mute my volume just in case. So January 2nd, 99, we have fittings of $2,000, right? So we're going to bank again because we're using this via check, $2,000. Okay. Next thing we're going to do is put the corresponding entry in the bank account. So we have fittings, and fittings is $2,000. Okay, so that takes us to the end of our second transaction, and in this transaction we bought machinery, furniture, and fittings by check. So basically we're using the bank account here, and the bank account is losing because we're taking money out of the bank via check to purchase the machinery, furniture, and fittings. Hence these are debited entries. Okay, now we're going on to our third, bought good for resale, $4,000 by check. So this whole word resale is just to confuse you. Basically you're buying something. Okay, so we're going to open a purchases account because we didn't specify what we buy. So once we say bought goods, we'll open a purchases account, and they say by check, so the corresponding account will be bank, right? So we could say On the debit side, because purchases are always debited, we have January the 3rd, 99, and the corresponding account is bank, and we bought $4,000 in goods for resale. Okay, so now we go in our bank account now, and we're going to put purchases of $4,000. Good. So we have that. So that's our third account. Transaction, sorry. We bought goods for resale. We just use the word sale just to tie up a little bit. But basically, it is a purchase transaction, and purchases are debited. And the corresponding account is the bank, and that is credited. So our next transaction is bought goods on credit from T. Lasalle, $2,400, and paid for stationery $150 cash. So we have a creditor here, T. Lasalle. We bought goods from him $2,400. So our purchases account again going to be debited, and we need to open up an account for T. Lasalle. Okay, and this is a creditor, so we can say this is a personal account. So in our purchases account, we're going to put January 4th. Sorry, January 4th, 99. We have T. Lasalle is the corresponding entry, so we're going to be T. Lasalle, we $2,400 on credit. And we're going over to his account on the credit side, because he gave you goods without collecting money, so technically it's credited. Okay, so January 4th, 99, we have purchases account, the amount $2,400. Okay, so that's the first part of our transaction. The next part said that we paid $150 for stationery cash, so we need to open a stationery account here. And this will be debited because we're taking money out of the cash account to buy the stationery. So January 4th, 99, we go in cash as the details, because that's the corresponding account, and it's just $150. Okay, so now we're going on the cash. Now on the credit side, January 4th, 99, stationery, and this is $150. Good. So we finished 4 transactions so far. I see how once you get the hang about which 2 accounts to open and how many accounts this transaction required to open, which account is gaining and which account is losing, we'll figure out which one is debit and which one is credit. Okay, so we continue it now. I have to do a 5th transaction here. January 5th, sold goods on credit to A. Pontin, $1,200, and J. Joplin, $1,600. So this is me selling goods now. So this is a sales, and remember, all sales is credited. So we're going to open a sales account. We're going to open an account for Pontin, A. Pontin, which is a debtor to our business. And we're going to open one for J. Joplin, who's also a debtor, right? And they bought goods from us on credit, so we selling goods now on credit. Okay, so this is January 5th, 99. I'm going to start with A. Pontin. A. Pontin, because this is in the corresponding account, and he credited $1,200 in goods, right? So now I'm going across the A. Pontin's account now, and he will have the debit entry. So we're going January 5th, 99. We're going to have sales, and the amount for that will be $1,200. Okay, and we're doing the same thing for J. Joplin. Keeping the date, we're just saying J. Joplin, and the amount for him is $1,600, and I'm just going across to his account. Right, I'm there. January 5th. We don't need to put the TH. 99. And this is sales again, and we go in with $1,600, right? So they are both debtors, so their account will be debited. They get the good, right? So their account is debited, and we lose by selling the goods on credit, so our sales account will be credited. And in general, the rule is all sales account is debited, right? I kind of run out of tables, so I just want to copy and paste a few quickly from another sheet. Okay, so let me just go on to copy. Right. Let me just go home, please. Peace. Okay, so I open up 3 more accounts to continue. The next one we have is cash sales of $900. So the 2 accounts we open in here is the sales account again and cash, but we already have those accounts open, so we're not going to open new account. We're going to use what we have. And in the sales account again, it will be credited, so we can go ahead and say January 6th. We're going to go cash, and it is $900. Okay, and then we're going up on our cash account now, and it will be debited, because if we sell something and we collect cash, that means the cash account is receiving. So we go in January 6th, 99 sales account, and we go in with $900. Okay, so that's the next transaction. Now we have purchases return. Okay, remember, all purchases return is credited in terms of accounts, right? So next transaction read A. Pontin return goods $180. So A. Pontin return goods. So we have to find back A. Pontin's account, and it will be $180, right? So wherever you see A. Pontin, which is right here, we go in January 7th, 99. We have cash. Once you don't specify bank, we usually say it's cash, and he returned $180 in goods. So where this is the credit account entry on A. Pontin, and the corresponding balance is cash, right? So we do not open our purchases return account. We usually use the accounts we have. So A. Pontin now is losing $180 worth of goods, and my cash account is gaining because he would give me back money, right? So that is January 7th, 99, A. Pontin, and this is $180, right? So now we didn't have to open no new accounts for that one either. The next one we're going on, owner withdrew $200 cash for his personal use. So when we withdraw money, we usually take money out of the bank and put it into the cash account. So in this transaction, we're using 2 accounts, which is bank and cash. He's taking money out of the bank and putting it into cash. Okay, so we have the owner withdrew on January 8th, 99. Going to put cash as the corresponding account, the details, because that's the other account we'll be using. And he withdrew $200. Okay, when we have cash now, the cash will be debited. So we go across here, January 8th, 99. Bank is the details because we open the other transaction in the bank account, and it will be $200, right? So that is our next transaction completed. So now we have bought calculator for $450 and typewriter $1,700, both by check. So we don't have a calculator account or a typewriter account. So in that's the 2 new accounts we have to open now, because they say by check and we have to use the same bank account from before. So we go in calculator, account, and typewriter, account. It could get frustrating, but if you're real good at it, these things shouldn't take you long. And the calculator account will be increasing, and the bank account will be losing, as we did with the furniture and fittings from before. So we go in January 9th, 99. We go in bank because he's using a check to buy all this, and it is $450. Okay, and then we go across to the bank account way up on top, and it is losing. So January 9th, 99, we have calculator, and this is $450. Okay, now we are going down back to the typewriter account now, and this is also debited January 9th, 99, and the details is bank because we're paying for it by a check, and the amount will be $1,700 as the transaction states, right? So now we're going on back to our bank account, and where we have January 9th, we don't need to put back the date because it's there already. We could just say typewriter because that's the account for the correspondent, and that will be $1,700, right? Now we go on again to another transaction which says purchase goods on credit. Just before they said bought goods on credit. Notice they're using the word now, purchase good for resale by check this time. Okay, so this time purchases debited and check is bank. So the two accounts will be purchases and bank. Okay, so we go in again. January 10th, 99, we have bank, and they purchased, according to the transaction, $2,000 worth of goods for resale via check. So we're going now back to the bank. I could just include, let me just get a ruler. Okay, so hold on. Right. So I just need to include some rows so I can continue my table. The good thing about Excel, I mean, you don't have to use Excel, but this is just for me to do things properly for you. So January 10th, 99, purchases return, or sorry, goods for resale, bought by check. So we go in purchases. January 10th, 99, we have purchases again, and they spent $2,000. So just verifying before I type the wrong thing. Okay, so $2,000. I just need to put my borders. Right. So we covered that. So purchase good for resale $2,000 by check. We usually use the purchase account debited, and the check account is basically the bank account, and that is credited. Okay, so we credited $2,000 in the bank account. Right, so cash sales $1,400. So cash and sales, right? So we have sales credited, so the cash account will be debited. So cash January 11, 99, we have sales again, and at $1,400. So I'm going down to my sales account, and January 11, 99, we have cash of $2,000. Sorry if my head keep bowing, I just have to look at the book, the laptop, and the phone, so it all changing. So cash sales $1,400. Okay, so now we have the next part of the transaction where he deposited $1,000 cash in bank. So the two accounts we're using, just like when we withdrew cash from the bank, and put it into the cash account. This is the opposite. We're taking our cash from the cash account and putting it into the bank. Okay, so in this case, the bank account will be debited. So we go in January 11th, 99. We have cash, and he is depositing $1,000 into the bank, right? And now we're going across to the cash account, January 11, 99. We have bank, and they took $1,000 from the cash account to deposit into the bank account. Okay, so always remember, when we withdraw and when we deposit, we're dealing with two accounts, usually the cash and the bank. If they specify anything else, which wouldn't be the case, you just fix the suit, but for now it's cash and bank. Okay, and think about it in your own lifestyle. So you deposit, you take $1,000 of your cash money and put it in the bank, and sometimes when we get paid, we take our pay from the account and withdraw it by ATM or whatever to get cash to buy things. So it's the same concept in our business. So the next part now, paid for stationery, $380 in cash. And if I recall, we have a stationery account open, and this account will be debited. So January 12th, 99, we have cash, and the stationery is $380. Okay, and in the cash account now, it will be debited. January 12th, 99, stationery, and it will be $380. So the two accounts we opened there is a stationery account. We didn't have to open back a new one because we already have one existing, right? So we have a stationery account and the cash account. Cash account debited because we take cash and bought stationery. Now we have paid sundry expenses, $80 cash. Sundry expenses are usually those minor expenses you have in a business, right? So we go in sundry expenses. We have, that will be debited because we take in cash, $80, right? So January 13th, let me rewrite that date, January 13th, 99, we have cash of only $80. Sundry expenses are usually very cheap. And we go in here, January 13, 99, and we have sundry as the details, and it is $80. So that takes me to the end of my transaction listing. And these transactions, as you will see on your screen, you just follow me as I do it. If you wish, you could draw the accounts in a notebook and follow along. So I hope that this has helped you understand and like bring back the idea of double entry into your heads so that you can properly understand it. I have opened my accounts. Surprisingly, I opened just enough to do this exercise, and I will post another video like it, but I just need to get feedback on if you understand. So remember to pause the video, make notes, and next thing, try to attempt all the exercises before after you watch the video. Do not rush the video and don't do the exercises, because then you'll end up in trouble and you'll be messaging me and asking me for questions that was already dealt with in the video. So watch the video, attempt questions, and if you have any further questions, you can call or text me, WhatsApp me, and I will assist you. So I really hope that this video is helpful, and just message me if you need help. Remember, ruler and pencil to draw your accounts, and use pencil to start your first set of T accounts, because you tend to be making a lot of mistakes and scratches never good in accounts. So I hope it was helpful.